Hey guys, Justin here from Simplified Investing. In this video, I wanted to discuss the option Greeks, implied volatility, and contract pricing to help those of you that don't quite understand the Greeks, what they mean, how you can use them, and basically to get an insight into each option contract in all the components that go into it. Before I get started, if you are interested in joining our private team with our alerts, our course, and our live streams, if you could check out SimplifiedInvesting.com, we would love to have you guys on board. If you could like and subscribe to our channel, it would be greatly appreciated. Again, we are doing a very big giveaway at 1,000 subscribers, so if you guys could help us reach that goal, it would be greatly appreciated. So basically, getting started, we'll go through GE, for example, so you can see GE's chart here. We'll go to this trade tab. This is going to be the Thinkorswim platform here. These are going to be the option contracts. So what are the Greeks? They're going to be Delta, Gamma, Theta, and Vega. Now, which two? Actually, here we'll go into something that has a little more contract volume, so you can see this better. So again, Delta, Gamma, Theta, Vega, this will be underneath Boeing option contracts. So the two that really matter the most are going to be Delta and Theta. Gamma and Vega are important in their own respective manners. However, Delta and Theta take the crown for being the two most important to pay attention to. So getting started, Delta is how much that option contract will move per dollar movement in the underlying. So this is for right here. So if Boeing goes to 165.60, this contract right here will gain 0.50, otherwise $50. So like you're looking at this, right, and it's, oh, that one's a lot higher, I want to pick that one. Well, it's all relative to the contract price, right? Yeah, this one's gaining $50 for $330 contract. Obviously, this delta's higher, but that's a $1,500 contract there. So keep in mind, it's relative to the contract price, not in that of just, hey, I'm looking for the highest delta. As you can see, this is going to cause you to have a very expensive contract with that highest delta. Now, what is Gamma? Gamma basically is going to measure the change in the rate of change in Delta. So how much will Delta move here? That's basically what Gamma is going to cover. Again, not that important of one. Delta and Theta are going to be the two most important ones. Again, one really, really big one, and I can't stress this enough for those of you holding your contracts overnight, Theta is the hugest, or I should say the largest Greek to look at. What is Theta? It's how much value your option contract will lose overnight, simply losing that time value of money on it. So you look at this one's going to lose $47, this one's going to lose $24. All option contracts in that manner will lose their value overnight. So pay attention to Theta if you are holding overnight. This is a very, very key concept. So again, like obviously these ones have the highest Theta, but again, it's all relative to the option contract value, right? This one's losing $20 overnight, but it's a $40 contract. So you're already losing 50% if Boeing opens up flat tomorrow just by that time value of money and Theta decay on that option contract. So the ones that are going to have the smallest Theta will be the contracts that are in the money and contracts with far, far out expiration. So like you can see these Thetas right here. If we click this option contract, look at Theta's hardly a factor here. So Theta is going to be the highest in the last 30 days to expiration and specifically the highest in the last week for out of the money contracts. So again, Theta is a very, very key component for those of you holding overnight. Keep in mind that options do lose value as you hold on to them, especially in the last month and within the last week. The last one, Vega, again, like I mentioned, Delta and Theta are going to be the two most prevalent ones. Vega basically measures the sensitivity to change in the underlying. So basically it's the percent change in that per 1% change in the underlying. Again, it's not very prevalent in the options scheme of things. Again, the two to watch out for are going to be Delta and Theta. And the biggest thing to remember is don't just chase the highest Delta, the highest or the lowest Theta. Look at it in relative terms to the option contract price. So again, Delta up here is obviously the highest, but that's a $1,500 contract versus a $600 contract here. And this is not something that you have to methodically try to time and say, hey, I got to wait for these deltas, these thetas, these vegas, these gammas to line up perfectly. That's not the case. You can execute your trades and everything not running off of strictly these Greeks. And one thing to note here is these Greeks aren't an exact science. They are an estimate of the contract price movement, but they are not going to be perfect in that, hey, Boeing goes up $1, this is going to go up 48 cents, or $48. So this is an estimate, not an exact number or percent change. So now into the last component, and the biggest component to this is I get this question a lot. Hey, Justin, I'm in calls for Boeing and it's pushing up. Why isn't my option contract price pushing up? Well, this is where implied volatility comes into. What is implied volatility? It basically measures how expensive those option contracts are compared to normal. So this is more expensive than normal 58% of the time. So these are a little more expensive contracts, and you may be wondering why. Well, Boeing also has a 737 MAX test flight coming this week, so the market is anticipating this. So what does it mean with a higher implied volatility? That means these options, whether it's calls, whether it's puts, are more expensive because the market anticipates a bigger move in the underlying. So the market's anticipating Boeing to move big off that news, so they're already pricing that into these expensive contracts here. So that is something to consider. When you have expensive contracts, in this case Boeing, for example, it will take a larger move in the underlying to see your option price move. So I'll see people playing earnings, for example, all the time. Oh, hey, it pushed up 20% after earnings or 10% and my option contract's losing value. That's because the market already anticipated that move and priced that into those option contracts before the move happened. So again, be very curious or lenient of this implied volatility level here. It is very prevalent in option contract pricing, and it will help you determine if that is going to be a good entry or a higher risk entry here. Two of them that I can think of off the top of my head that are going to be very prevalent to being very expensive contracts: Tesla and Zoom. They always move, and they're a larger beta stock, so that the market anticipates these big moves in those underlying. So the market knows that Tesla, for example, is going to be very volatile, so Tesla has to move more for your option contract to move. So again, watch for implied volatility. If we go to something like Penn Gaming, for example, we go to their contracts here, 88%. So that's a very, very expensive contract because the market is anticipating this large move here in the underlying, and it will take more of a move in Penn Gaming to see your option contract move at all. So again, I hope this video helps you guys understand the Greeks some more. If you have any questions or comments, please feel free to leave them down below. If you could like and subscribe to our channel, it would be greatly appreciated. And if you are interested, again, in getting our daily trade alerts, our course access, our live streams, and team of over 1,100, we would love to have you at simplified-investing.com. I wanted to run through with you guys real quick how we finished the day here. Starting right here, we had two great plays on Beyond here today. Beyond 175 call here, played it again here. I want to show you the value of our private team for you, those of you that are looking to get started. These are all going to be profits here from simply playing our alerts, right? $494 on Beyond, more Beyond plays here, up $230. Look at all these plays coming in here from Beyond. Again, this is what our private access members get. If you sign up on our site, you get access to our daily alerts here, as well as mentoring from myself if you need help. Right here, Bader making $93 in 9 minutes, $620 an hour, not bad at all. Lando making $6,000 here on the day, simply following them. All these are coming directly from our alerts. So if you are interested in getting alerts that can help you take your trading to the next level or even help you learn and grow as a trader, we would love to have you guys on board at simplified-investing.com. I hope you guys all had an amazing day. And again, if you have any questions or comments, please feel free to leave them down below. Thank you.